Welcome to Supply and Demand, the podcast where we explore the hidden stories of global finance. Today, we're uncovering the history of banking system, starting from President Nixon's decision to take the US dollar off the gold standard in the 70s. We will explore key historical events like the US government's gold confiscation in the 30s and discuss how people can protect themselves today from the increasing government and banking control. To understand today's banking system, we must first go back to the era of the gold standard. This was a time when the value of currency was directly tied to the gold reserves. For every dollar printed, there needed to be an equivalent amount of gold in government vaults. Key dates in the gold standard history: 1870 to 1914. Many global powers adopted the gold standard, ensuring currency stability. In 1929, the Great Depression caused severe economic distress, triggering a chain of events that changed the global financial system forever. In the 1930s, global trade declined, forcing countries to abandon the gold standard to stabilize their economies. Gold-backed money ensured currency stability, but limited how much money governments could print, forcing them to maintain fiscal discipline. This foundation laid the groundwork for global trade and economic cooperation, though it came with the constraints that would eventually lead to its demise. The gold standard created a stable yet rigid monetary system. International trade flourished, but was often disrupted by geopolitical events and economic crises, highlighting both its strengths and limitations. The gold confiscation of 1933, one of the darkest chapters in US financial history, was Executive Order 6102, signed by President Franklin Roosevelt in 1933. The order made it illegal for Americans to own significant amounts of gold. Here's what happened. Citizens were required to turn in their gold coins, bullions, and certificates to the government. In exchange, they received $20.67 per ounce, far below market value. Once the gold was secured, the government raised the gold price to $35 per ounce, effectively devaluing the dollar. This event demonstrated how quickly governments could seize personal assets during a financial crisis. It also set a precedent for future interventions in personal wealth, showing that financial security tied to government-backed currency could vanish overnight. This move was justified as a way to stabilize the economy and combat deflation, but many people argue it was a blatant government overreach that prioritized state power over individual financial freedom. It remains a cautionary tale about state intervention in times of economic uncertainty. Fast forward to August 15, 1971. President Richard Nixon made a historic announcement that would reshape global finance. The US dollar would no longer be backed by gold. What were the reasons behind Nixon's decision? Mounting US debt due to the Vietnam War and domestic spending, international pressure from countries like France demanding gold redemption for their dollars. The US dollar became a fiat currency, meaning its value was based solely on government trust. Inflation surged and global currencies became more volatile. Central banks gained unchecked power over money supply, creating today's system of limitless money printing. The world's financial system shifted to a floating exchange rate model, causing currency wars, inflation cycles, and greater dependence on central bank policies. These decisions reshaped global trade and monetary policy for decades to come. Today's banking system is built on the fractional reserve model. This means banks are only required to hold a small percentage of deposits in reserve while lending out the rest. Banks create money by issuing loans, inflating the money supply. In crises like the 2008 financial meltdown, risky lending caused massive global instability. Central banks, like the US Federal Reserve, can print unlimited money to bail out failing banks, but this devalues the currency over time. During the 2008 crisis, trillions of dollars were created to stabilize failing institutions like Lehman Brothers and major banks worldwide. This bailout shifted economic power even further into government hands and caused significant economic disparities. Internationally, countries with weaker currencies suffered as investors fled to the US dollar, creating a cycle of dependency that still shapes global trade and investment flows today. Given this history, how can individuals protect themselves from government overreach and banking system failures? Number one, diversify wealth. Precious metals. Consider holding physical gold and silver as a hedge against inflation and currency collapse. For example, during the 2008 crisis, the gold prices surged as investors sought safe haven assets. Cryptos like Bitcoin offer an alternative to government-controlled currency. For example, Bitcoin's supply is limited to 21 million coins, making it inflation-resistant. Diversify accounts across stable global economies to reduce exposure to any one country's financial policies. Another good example is to own tangible assets, like real estate, can provide long-term value regardless of currency fluctuations. And of course, stay informed about economic policies, government regulations, and alternative investment strategies. Following global financial news can help individuals anticipate and prepare for economic shifts. Investing in precious metals, ETFs, blockchain-based financial instruments, or even private offshore trusts can further diversify wealth and increase financial resilience. Looking ahead, we face a world where central bank control may intensify through technologies like CBDCs, central bank digital currencies, and increased surveillance. Digital currencies could offer unprecedented convenience, but also give governments even more power to monitor and control individual financial behavior. What are the possible future scenarios? Governments worldwide may adopt centralized digital currencies, eliminating the need for cash. A major financial crisis could prompt another global economic reset, similar to the Nixon-era decision. Stricter banking regulations could limit individual financial freedom while attempting to prevent economic instability. History showed us that government control over money can expand rapidly in times of crisis. Diversification, alternative assets, and financial literacy are key to preserving wealth and maintaining autonomy in ever-changing financial landscape. Thank you for tuning into Supply and Demand. Subscribe, like, and hit the notification bell for more deep dives in the hidden stories of the financial world. Until next time, stay informed, stay prepared, and protect your future.